Good morning, everyone. We are going to start our webinar. My name is David Kalis. I'm a partner at Future Fund Advisors. With me is Gary Black, which I'm sure you are all familiar with. What we're going to do for the next 30 minutes or so is talk about our 506C private placement offering for Future Fund Advisors, which is a parent of the Future Fund, our SEC investment related firm. What I'm going to do is go over the offering for a few minutes. Then we're going to move it to Gary. He's going to talk about the firm and our growth path. And then we'll come back and talk a little bit about the growth market and the stock market in general. So as we go through the presentation, which you'll see up on the screen, I want to talk about the offering a little bit. It's $5 million in a private placement offering. And we're offering this as a partnership to outside investors in a non-voting format. It's going to be a $10 unit per, and it's only for accredited investors. And what that means as accredited investors, it means that you have to have a minimum of $200,000 of individual income for the last 2 years, or $300,000 on a joint basis, or $1 million of net worth. If you're interested in understanding more about that, looking at our documents, the PPM, and getting verified, you can look to our website, which is invest.thefuturefund.com. And as you get to the website, you can register. You can see that the PPM is there with all the risks and disclosures. You can see all the sub-documents, and then you can get verified. And verification is pretty easy. Either you can upload a document from your CPA or attorney, or if you don't have that, we can do that for you through a third-party vendor, which is private. So the process is actually pretty easy. As we go through the presentation, you'll see we have a chat available. And if you have any questions, please ask, and we will answer them at the end of the presentation. So what I'm going to do now is turn it over to Gary, and he's going to take us through, the firm, what we look like today, what our growth path is going to be for the next 5 years as we move to $1 billion of assets under management.
Good morning, everybody, and thanks for joining us today. We believe we're in a great opportunity to invest in an asset manager that focuses on growth investing. And I'm going to give you 3 reasons. One, we had a sharp decline in growth stocks since November 2021, which is when the Fed started raising rates. You can look at Russell 1000 growth. It was down 26%. Russell 1000 value is down 8%. So growth looks cheap today. Second, we believe that the Fed will pivot at some point in 2023 as inflation continues to retreat. We saw this morning another pretty good inflation report. If you look at just the last 6 months, core inflation is about 4.7%, but the headline inflation is actually pretty close to the Fed's goal of 2%. So we believe as we get into the first and second quarter, we'll hear more about the Fed pivoting on interest rates, which is usually pretty good for growth stocks. And then the third reason why we think this is such a compelling opportunity, if you look at the active ETF space, it continues to grow very, very fast. If you go back to 2012, that business was about 10 billion in assets. Today, it's about 350 billion. So that's about a 40% compounded growth rate over the time. Our growth plan is to expand the company into new strategies. So specifically, we're looking at a long-short ETF. We're looking at other hedged equity products. We're looking at separate accounts. We have a SMID product, which I'll talk about in a minute, and sustainable growth. And investing in our company today now offers the opportunity to get into early stages of this growth, where the goal is to reach $1 billion over the next 5 years. And so if you look at this chart that we just put up, we have 2 main objectives as we think about investing. And one is to try to find the best secular growth opportunities, and 2 is to discover uncaptured equity values. And if you look at the bullet points off to the right, the way we invest, we're very concentrated, we're very high conviction. We have a long-only product today, but we will have a hedged equity product. We focus on megatrends, long-term megatrends in the marketplace, and I'll talk about them, that we believe have not been fully recognized by investors. They act as tailwinds for our portfolio. On the long side of the market, we look for companies that have the strategy, the products, the culture to exploit these megatrends. And on the short side of the market, we invest in companies that we believe are at a strategic disadvantage in their markets and will lose out as these megatrends take place. We look for transformative companies that will displace the legacy industry incumbents. So if you think about, a Tesla versus Ford and GM, and where we find the threat to existing businesses are high, those are candidates that we look at for shorting. So let's just talk about the mega trends real quick, because that is the core of what we do. You can see at the bottom, these are the 10 mega trends. They're long-term trends. They don't change year to year. But if you think about them, they're social networking, mobility, e-commerce, climate sustainability, automation, big data, people living longer, fintech, lifestyle betterment, which includes anything where people want to spend money to improve their lives, and 24/7 information and entertainment. And again, what these mega trends do is they act as tailwinds for the portfolio, but they disrupt legacy players who don't adapt to these mega trends. And so we try to find the companies that can most exploit these trends and capitalize them, and that can build good profitability because they've invested in them. And that's the type of candidate that we look for on the long side. And on the short side, we look for those that really are poorly positioned or just don't anticipate these mega trends, and those become good short candidates for us. Next page. Okay, I think one of the strongest reasons one might want to invest in our business is because of the people. Dave and I both grew up in the institutional world. You can see my background at the top. I started as a research analyst at Sanford Bernstein. It was a $60 billion institutional player. We had great research, and we had a private wealth business. We then sold to AllianceBernstein, and many of the partners, I was a partner. I became a partner after about 3 years there, left. I went to Goldman Sachs Asset Management. I was the CIO for their active equities business, which is distinguished from their quant business. I had about $75 billion of assets under my management. From there, I went to Janus. I went in as the president, became the CEO after about a year. That was about $150 billion asset under management company. It was also the CIO. From there, about 2009, I decided to go out on my own. I started Black Capital, was the founder of it, and in 2012, got a call from Goldman Sachs, and they wanted to introduce me to John Calamos, who was the CEO of Calamos Investments. He bought our firm and made me the global co-CIO. And I stayed there for about 5 years, then left and went to Aegon Asset Management, which I ran. I was the CEO of the US business, which was about $120 billion of assets, and left there a few years ago to start Future Fund. Dave has an equally great institutional background, including being a partner at Siegel Bryant Hamel. He worked at Northern Trust as a portfolio manager. I hired him at Calamos, and he was the head of our U.S. growth strategies and a PM. He was managing about $6 billion under him, and then he left, and he and I linked up in 2021. We have very similar investment philosophies as it relates to high conviction investing, how we think about growth stocks. We like good secular growers, but we don't want to overpay. We're very conservative in the way we manage money in the growth space. I think we have a great board. If you've looked through the materials, you'll see 4 people who are advisory board, and the advisory board is really here to guide us and act as a sounding board on products, on distribution, and even some ideas that we might be thinking about investing in. They're all a little bit different. You may know some of them. Rich Bindler, I've known for over 20 years. He had been at AllianceBernstein on the private wealth side. He actually ran the Chicago office where we're located for several years, but he's run a bunch of the private wealth businesses, and he's already shown a lot of aptitude for wanting us to try to get more assets and how to think about approaching clients. And he was actually the chief client officer at AllianceBernstein. He's now an advisory board member at Crescent, and he has his own D-SPAC fund. It's about $11 million fund. So he's an investor, and he's also a distribution expert. Ross Gerber, many of you know Ross. Ross and I are good friends, I think, from what I could tell most days. But Ross and I like each other very much. We respect each other. He runs the $2.2 billion Gerber Kawasaki Wealth and Investment Management firm. He and I both went to the same alma mater, University of Pennsylvania. And Ross is just, a great person to think about how to run the business. Alexandra Mertz, many of you know Alexandra as Tesla Boomer Mama on Twitter. She's got so many great ideas, and she's very disciplined. She tells me what I should be doing all the time, and I don't mind it because of just the way her personality is. She can actually give advice without people getting offended. And, those of you who've seen it, she's got Substack, she's got letters. She's been a big advocate of the Tesla doing a big buyback, and, she and I talk a lot. The fourth person, again, great background, Jeffrey Yu. He's trained as a physician in radiology and nuclear medicine, but he's also been a very successful entrepreneur. He's a founder of 2 healthcare technology companies. And again, Jeffrey and I talk pretty much every day. So we like having our board because we want them to give us feedback. We want them to be a sounding board. We want them to help guide us in the right direction and help with both investment performance and getting clients. Okay, next. Okay. So if you think about our marketing distribution strategy, it's really got 4 prongs. One is new products. So we want to leverage the research expertise we have in growth investing, and we want to launch a new long-short ETF. We want a new long-short hedge product. It would likely take the form of a fund. And then we want to also have SMAs offered as well. And then we'll talk more about some products, but we also think about a SMID product, which is where Dave started in the SMID space, and that small and mid-cap growth space, where there tends to be information advantages because the companies are smaller and not a lot of the big companies, a lot of the big asset managers look at them all the time, and you can get closer to the management teams. And we also think about sustainable investing, although of course that has the bloom is off that rose, but we do think we could do that as well. Going down in terms of distribution, we're going to continue to build the relationships we have with financial intermediary platforms with our active ETF products. So one of the things we want to do is hire a full-time salesperson. It's been Dave and me so far. We have a person that we use today, but we'd like to make sure that we can really leverage the distribution capabilities out there, particularly with the prime brokers that we have today. And then if you look at the top part, we are having discussions with a couple institutional players who we think could act as partners for distribution. And again, these are folks that if we had a we'll call it a liquidity event down the road, this would be where a good chance would be that it would come from, because what I found in my experience is that when you work with somebody very closely, they get to know you, they get to trust you. And if we had as a distribution partner one of the big institutions that wants to be in the ETF space but isn't there today, or wants to be in the growth space but isn't there today, they would tend to be interested in taking a bigger equity position for us. And then the fourth prong, which is just marketing, is our goal is really to build assets in FFND, which has a 1-year track record. We have a Tesla covered call strategy today we use. We try to get press, but we don't want to go overboard on getting press because our primary job is to build performance. But we do believe that there's an opportunity in the long short space on the ETF. So we already have a product that's ready to go. It's been approved by the SEC, and it's registered on the New York Stock Exchange as FFLS. And we'd like to get that launched. And that's one of the reasons why we're doing this capital raise today, is to put money into that. We also have a leading PR and marketing firm that has helped us get spots on CNBC, Bloomberg, Fox. Both Dave and I have been pretty active in this space. And again, we don't want it to take up so much time that we're not focused on performance. But we do think, a couple of these high profile features a month is good business for us. Obviously, I have a very loyal, very big Twitter following. Thank you for that. If you follow me, we have now about 280,000 followers. So you can see in about a month, we've increased pretty substantially because of all the controversy associated with Tesla. And we continue to do YouTube events all the time. We did one the other night. Alexandra Mertz, myself, and Farzad, and we had about 20,000 participants. So these are good examples of situations where we can talk about investing, why we like some of the positions we have, and other things. We will continue to talk about how the future fund is investing in change the world type megatrends, and we think that's a good way of building our brand. And then one of the things that we will be doing more of is just talking about the opportunity for growth stock investing. As most of you know, growth and value take turns. Generally, growth stocks do not work when the Fed is raising rates, and they do work when the Fed is lowering rates. So we think we're in a position where the Fed will start lowering rates sometime in 2023. And then we'll continue to work with the journalists that we know. We have very good relationships with most of the media, and they trust us. We have credibility because we talk both pros and cons, and we think we can continue to leverage those. Okay, on the next slide, we show our growth trajectory based on products. So where we are today, we have the Future Fund Active ETF. We have a covered call strategy. The next products will be FFLS, which will be the long short ETF, which we're very excited about. Both Dave and I have a long history of shorting stocks successfully. And, if we had launched FFLS when we launched FFND, we'd probably be in a little different situation because that strategy would have worked really remarkably over the last 18 months. But we still think the markets will be choppy over the next couple of years. It's not clear to any of us, and including Dave and I, that, the Fed's going to pivot when they're supposed to, and they may keep it raising rates even longer than we expect. With today's inflation number, we expect about a 25 basis point increase on February 2nd. And I think if you look at the futures, I think it's about 100% odds people are putting on that. And then I think they're going to hold for a while. They'll have another meeting in March, but that'll put the rate at 4.5 to 4.75, which would be below the 5% that they showed in their dot plot in December. And if that happens, the next step will be people will start anticipating that rates are going to come down, especially if the inflation numbers continue falling as they have been the last 6 months. Just finishing out the chart, we're looking at a future fund, long only SMA. We're looking at a long short hedge fund, and then a SMID product in the future as well. So when we talk about growing, we want to have innovation. We want to have new products. We can't obviously do everything, but we want to stick to what we do well. And I think the next 12 months could be very exciting for us. Okay, one of the most important charts in the deck is this one. It shows our growth trajectory from where we are today. If you look at our 13F that was filed in September, about 50 million in assets, and we think this is a reasonable, conservative but ambitious growth trajectory. Our goal is to get to $1 billion in 2027. And again, I just want to point you back to both Dave's and my experience with big asset management firms. We've managed big AUM before at both the firms for both of us at the firms we've been at before. But at $1 billion in AUM, if you look at that last column, because the fees on long short tend to be higher than they are on long only, the average fee goes up to about 1.15%. That would put us at about $11.5 billion in revenue by 2027. And we think we're being conservative on our cost. Dave and I are both pretty frugal guys. We don't really spend much money running the business, and we outsource everything. And that's a good thing. And it could be a challenge to us. But we look for about $7.5 million in what we call operating profit by 2027. If you look at what asset managers trade at today, and you can look at BlackRock, T. Rowe, Janus, AllianceBernstein, they trade on average at about 10 times enterprise value to EBITDA. If you put an average industry multiple, which those companies are going to be growing, far slower than what we believe we can grow at, that's 7.5 million times 10. That'd be about a $75 million valuation by 2027. And if you want to think about, well, what is that worth today? If we were to discount that back, let's say at 20%, and you have to use a higher discount rate because it's a more risky proposition, and it's more of a venture capital type discount rate. If you were to discount that back at 5 years, that would be worth about $30 million in today's value. Okay, let me turn it back to Dave, and we can talk about the case for growth.
Okay. Thanks, Gary. So obviously we would, we'd like a tailwind to our business. And, from our perspective, 2022 was obviously a bad year for investing in general, and especially for growth stocks, but actually started in February of 2021. So this has been going on for 2 years now. And, a combination of, what happened post-COVID with both valuations and low interest rates. And a lot of these stocks just got to a place where they shouldn't have been. And this is obvious in retrospect. I mean, some of these stocks, which are still good companies, like, a Snap or DocuSign, are down, 75, 85, 95% from their highs. So obviously, the bloom is off the rose on a lot of these, what we call higher growth stocks or speculative stocks. So what that means is, and I understand everyone's discouraged about the market and people have lost money, but the reality of it is that if you take a perspective of looking back and looking back a little bit on what's going on in the market, you really want to buy low and sell high. And these valuations for growth stocks are very good today. And we're seeing a lot of things in the market where it does appear things are bottoming out. So obviously the biggest thing for growth stocks from a macro perspective are interest rates, as we discussed. And if we turn to the next page, you can see the next 2 pages where interest rates have been. First of all, let's look at what growth stocks have done versus value. And that's kind of obvious. We've seen that growth has really underperformed value over the last year or so. Everyone knows that, as we talked about with some high growth stocks really crashing. But if you go to the next slide, you can see where interest rates have been over the last year and a half or so. And it's not necessarily that interest rates have gone just from essentially zero bound to 4%. It's the rate that they've increased at. And this is really unprecedented. And, we all know what the Fed said about transitory and how he stayed at zero bound for too long. But the shift has been massive. And obviously, when you raise interest rates like this, it takes a while for it to get to the system. And that's what we're starting to see now. For the first time in many, many years, we're seeing a lot of the large cap growth stocks start to lay off people, reduce headcount, reduce costs. So that's starting to work through the system. But the point being for growth stocks and the market in general is that this rate increase is essentially over in our minds. We're at about 4.25 on the Fed funds rate, probably looking around 5% peak. So and that's going to be maybe mid-year or so. And as the market starts to discount that's only 6 months out, you're starting to see the market get more attractive from an investment standpoint. Stocks, large cap growth stocks are starting to bottom out a little bit. Small cap speculative stocks are starting to come back a little bit too. Some of the stocks that have really gotten beaten up are starting to find a bottom. So if interest rates have peaked, that's very important. Now, why have they peaked in our mind? Well, it's essentially because of inflation. If you go to the next page, you can see what the market thinks about forward inflation. And the Fed looks at a lot of different things. They look at the actual print for CPIs, they look at employment, but what they really look at though is what are market expectations? What's the liquidity in the market? What does the market think about where inflation is going to be? Now and we did this presentation, this is for November, I think, but for December, this is a monthly number. 1-year forward numbers have come down to about 5%. So the market is anticipating that inflation over the next year is going to be around 5%, which is way down from the 6-7% that they were thinking only a few months ago. So interest rates have peaked, inflation has peaked. The most important thing is in the next page is where you look at what the market thinks long-term expectations are going to be for inflation. So as you can see, this is 5-year forward break-even rates. So this is the market's expectation of where rates are going to be 5 years into the future. And you can see point to point that really hasn't changed all that much. Obviously, inflation expectations really came down in 2020 because of COVID, but they've kind of stayed now and settled in that 2 to 3% range. So the market is settling on near-term inflation is peaked, it's starting to come in, but long-term inflation is under control. And that's really what the Fed wants to focus on, because if inflation sort of in the medium to long term gets unanchored, they're really going to have to move. So from perspective of what that means for long duration growth stocks, I want to give you a couple of perspectives in the next 2 slides. So the next slide is what we look at is big growers price to sales ratio. So think of this as valuation, and this goes back all the way to 1960. So this is over 50 years of data, and you can see there's 4 points in here where the market for growth stocks really peaked. You're looking at 1975, you can see 1980, 82. You can see in 2000 when the internet happened, and then post-COVID, which was 2000. So you see there's just 4 distinct peaks of growth stocks. You can also see at the bottom here where they come in and what the valuations look like today. Right now, big cap growth stocks are essentially trading at the lowest valuation they've traded at for 50 years. And, that tells us something. So if you take that combined with interest rates peaking, with the Fed peaking and low valuations, we think the market is set up pretty well for growth stocks to do well over the next couple quarters and into the next 4 to 5 years. Also, if you look at the momentum in the next slide of what big cap growth stocks have performed, it's not just that they're cheap, and it's not just that rates have gone up. It's that it's the volatility or the momentum, the negative momentum for large cap growth stocks. You can see here, this goes back, over 60 years to 1952. Big cap growth stocks have never had this amount of negative momentum. And this goes back to 1980 in the recession. And this actually goes back to the dot-com bubble. So you can see, if you take a perspective and try to focus a little less on the day-to-day or the week-to-week, you can see from a long-term perspective, interest rates have peaked, inflation has peaked, it's under control as far as we can see with the Fed, and large cap growth stocks. And even it's the same thing for sort of mid and small cap growth stocks. It's even more extreme. Are showing some attractive valuations, and the correction has been so swift. Even though it feels like 2 years is a long time, which it is for an investor, but the valuations have come in and the momentum has been so negative. We feel pretty good about the next couple quarters, the Fed, sort of the market bottoming out, and over the next 5 years. And also, as Gary mentioned, we also do anticipate there's going to be volatility through this period. There's a lot of other things that are going on macro-wise. You've got, obviously things going in Russia, and you probably will see a pretty significant slowdown in the economy. We're not necessarily calling, for a recession, but we're generally going to be, around that 0% growth rate for, as we get into the back half of the year. When that happens, generally growth stocks do pretty good. So we think the setup is pretty good. As I said, there is going to be some volatility. That's why we're also introducing some strategies that will address that volatility. So as we roll out our product set and our strategy set, we'll have some long only strategies across market cap that are concentrated. We'll also have some hedge strategies so that we can fill out our strategies and really grow our assets and really push towards that goal of $1 billion of assets under management. So what I'm going to do now is hand over to Gary, and he's going to wrap up for us. And we have some questions coming through, and we'll answer them post this.
So let me summarize quickly why we think now is a really good opportunity to invest in future fund advisors. So one, we think we could get to $1 billion within about 5 years, which is about a $7.5 million EBITDA number, which we talked about. We are seeking to raise up to $5 million, which would put a post-raise valuation on the firm of $15 million. I'm going to come back to that in the Q&A. We believe that, as Dave just said, as inflation retreats and the Fed pivots on interest rates, this is the right time to be investing in growth stocks. And we're the type of firm, because we're high conviction, we're concentrated, that can capitalize on that. The people, you have to believe in the people. And Dave and I have worked together for many years. We both have similar views about the markets, about how to invest. We're very price disciplined, and we have a lot of experience. We've been doing this for 50 years combined. And then think about the new strategies. As Dave said, it's going to be a choppy next couple of years. We don't know how deep, if there is a recession, how deep it's going to be. But we think a long-short set of strategies, an ETF and a hedge fund product, could get a lot of interest. What we found is we've talked to people about raising capital. That's what people want from us. And I would bet that if we were going to have a liquidity event, which I know anybody who puts money in this firm has to think about, how do they get their money out? That is the most likely scenario of what would happen. We would have somebody who approaches us and says, we like ETFs, or we like growth, we like what you've done on long short, and we'd like to be a distribution partner for you. If you have more interest, go to, you see the website at the bottom. The process for registering takes literally about 10 minutes, invest.thefuturefund.com, and a minimum investment is $10,000. Okay, so let's now open up for questions. Dave, want to lead us?
Okay, first question, I'll leave this for Gary, is, so you're talking about from an investment standpoint and a return standpoint. So your goal is to get to $1 billion of assets under management. We talked about the operating profit there and what the multiple could be. So how can one frame what the return on investment could possibly be for investment in our partnership if that plays out?
Okay, so We're raising money at we'll call it a pre-raise valuation of 10 million. And we talked a little bit about how we get that, but that's not the most important thing. The most important thing is where are we going to be 5 years from now? So if you accept our numbers of $1 billion of AUM and $7.5 million of EBITDA and a 10 times multiple, that's $75 million. So if you take 75 million divided by the 10 million, even if you use 15 million, because we're trying to raise 5 million. So from a post-money raise, take 75 divided by 15 and try to figure out what is the return on investment that over 5 years. It's pretty close to 40%. And so that's a 7-fold return on your money. So that if you invested $100,000 and we can meet the objectives that we've laid out, both on product side and a distribution side and a marketing side, that $100,000 could turn into $750,000 if we can hit our numbers. And that's the way you want to think about ROI. It's about a 40% per year return if you want to look at just post raise of $5 million.
And a comment I'll make on that. I mean, in my experience has been, I started a number of products over the last 25 years. And once you get a 1 year to maybe a 2 year track record, you really have what's called an S curve in the investment management business. You got to get your record behind you and you really start to gather assets. So in my opinion, personally, $1 billion is not a stretch goal. In my last year at Calamos, I raised $1 billion. At Siegel Bryant Hamel, I took products from 0 to $500 to $600 million in a couple of years. So it's really a momentum business. It's really getting some performance behind you. It's really getting the name and the brand behind you. And the other thing I would say is when we started the firm, we took a white sheet and we didn't want to be just a commodity asset management firm. We wanted to start a brand, which is really starting, it takes time to build a brand. And with Gary on TV and the tweeting and the exposure to Tesla, we're really starting to get the brand out there. So that's unquantifiable and intangible, but it's starting to get out there. The way we invest in concentrated portfolios, we're not looking to be a quasi indexer. We're going to have a lot of active share. We think that's important. And with that, we think the fees should be higher too. So that's why we're positive, not just about, the structure of the business from, a fee standpoint and a growth standpoint, but we do think we have something unique here. And I think once we get this capital raise done, we can really get out there with the marketing distribution, which really is what we're missing at this point. All right, so another question would really be around infrastructure, and I will answer that really quickly. I spent the first 6 months here just building out the infrastructure of the firm. And obviously, we're SEC registered, so it's a highly regulated industry. We have to report our assets every quarter. We have to report any changes every month to the board of our ETF. We have a 40 Act fund. So we've outsourced most of our things. We have our compliance outsourced, we have our IT outsourced, and a lot of our other functions outsourced. But we're using best of breed in that area. We're using best of breed in our trading systems. We're using best of breed in our accounting systems. So we are really set up from the beginning to be running multiple billions of dollars under management. So as I said, as we do raise this money, it's really going to be focused on new strategies and rolling out some salespeople and getting into distribution. So that's really the key of where the capital raise is going to be. Okay, as far as any other questions we have here, why do you have two classes of stock? And could you just, kind of, Gary, maybe talk about what that means and for investors, and then maybe distributions, and is everyone treated fairly? Because I think that's been a question we've had a couple of times.
Sure. So let me hit the distributions first. If we have profits, just know that any initial capital that Dave and I have invested, anything going forward will be done pro rata. So if you invest, say, 1% of the firm, you will get 1% of the profits. There will not be any distributions to Dave and I as initial, or any of our other investors. We have other investors. Everybody will be going forward pro rata. So you don't have to worry about that. In terms of two classes of stock, we want to make sure that we have control. We've both been in situations, meaning we retain control as we get bigger. We've both been in situations where if collectively Dave and I went below 50% of the ownership, there's things that could happen where we can't control our own destiny. And we have to make sure that going forward, as we think about distribution partnerships, which is where we'd most likely get a liquidity event from, we want to own at least 50% of the stock so we can be doing the right thing for the long-term interest of the shareholders. And that's why we created a two, non-voting and voting structure. But from a distribution standpoint of profits, there'll be no difference. It'll be pro rata. based on the ownership of what you own, and the same with Dave and I. Just be clear about that.
Right. Okay, we're hitting about a half hour right now, so I think we've covered, you know, most of the important questions. But once again, if you want more information, you can go to the website that, you know, we've tweeted out a few times, invest.thefuturefund.com. Gary and I are also available for you know, for any questions. You can email us and we can go from there. But we do appreciate your time in taking and learning about Future Fund and Future Fund advisors. And, you know, please take some time, look at our portal, look through our PPM, which has all the risk disclosures and some more detailed information about the firm. And we'd appreciate your investment. All right.
And I just want to add, we will be doing a Twitter Spaces event in the next couple of days, either tomorrow or Friday. We're going to set that up so people could ask more questions, because I know we haven't really left that much time for questions. And I just want to say, look, in my history of investing, I've been doing this for 20, 30 years now. I've never been more excited about the growth space because of the things we talked about at the very beginning. In terms of the Fed, it looks like it's about to pivot. It just may take another 6 months. And because growth stocks, and most of the people on this know Tesla so well, they've never been so cheap, as Dave showed in some of his charts. And so those two things, plus the very, very quick growth of the ETF space, are why we're so optimistic about our future. So I want to leave you with that, and we'll be talking to you again if you want to tune into one of our Spaces events, which we'll be doing. Look for that. We'll be setting it up in the next couple of days.
All right.
Okay. Thank you, everybody.
Thank you.